Inflation and recession have been pressing issues in the United States lately, and financial experts like Robert Kiyosaki and Jim Rickards have voiced their concerns. Kiyosaki, the author of the best-selling book Rich Dad Poor Dad, has warned that the current economic environment is unfavorable for savers and investors. On the other hand, Rickards, a prominent economist, has been vocal about the dangers of inflationary pressures. In fact, he has advised individuals to protect their wealth by investing in gold and other safe havens. And in this video, we will explore their insights and shed light on the current economic situation in the US. Hey friends, welcome to Capitalista. Before we dive in, please take a moment to hit the like and subscribe buttons down below. And now, let's get started. The global economy is greatly affected by events that occur in the United States, since it holds the title of being the largest economy in the world. The US dollar is also the world's largest reserve currency. This means any changes to the US economy or policies can have ripple effects across the globe. For instance, if the US enters into a severe recession or financial crisis, other countries' economies may suffer due to the interconnectedness of global financial markets. Additionally, changes in US trade policies such as tariffs or sanctions can have far-reaching consequences for other countries and industries. Now, the US Federal Reserve has recently been raising interest rates to combat inflation and achieve its goal of bringing inflation down to 2%. The Fed has raised interest rates rapidly, with the policy rate rising from 0% to 4.5% in just 8 or 9 months. The Fed's plan is clear, and that is to reach a terminal rate high enough to bring inflation down without further hikes. The estimated terminal rate is around 5.1%, which means that the Fed will continue to raise rates until they reach this point. However, experts like Robert Kiyosaki and Jim Rickards argue that the Fed has already reached the terminal rate and that continued rate hikes could lead to a severe recession and increased unemployment. So again, the Fed is currently focused on finding the terminal rate, which is the interest rate that is high enough to bring inflation down without the need for further rate hikes. And basically, the idea is that once they reach this rate, they will hit the pause button and wait for inflation to come down to their target of 2%. According to the Fed's projections, the terminal rate is estimated to be around 5.1%, possibly 5.25%. The Fed has already raised rates 4 times since March 2022 and plans to continue raising rates until they reach the terminal rate. However, there is some debate over whether they have already reached the terminal rate and are continuing to raise rates unnecessarily. The market is hopeful that inflation is on the decline. Still, it's uncertain whether it's due to the Federal Reserve's interest rate increases or if it has already reached the terminal rate. And with the possibility of a severe recession looming, Jim Rickards suggests that individuals should take steps to prepare their portfolios for potential market volatility. In addition, Robert Kiyosaki recommended strategy is to reduce equities exposure and invest in more stable assets such as treasury notes. Holding cash is also recommended as it provides optionality in market downturns and allows for purchasing bargain assets. Investing in residential and income-producing real estate is another strategy, as they are less volatile than commercial real estate and can provide a reliable source of income. Lastly, allocating a small portion of the portfolio to gold and silver can act as a diversification tool and hedge against inflation. As the Federal Reserve continues to raise interest rates to combat inflation, the US is heading towards a severe recession. This will ripple effect on businesses and their employees, leading to more layoffs and unemployment. Companies like Amazon, Target, and Twitter have already started laying off employees, and small businesses will likely follow suit in the coming months. It's important for individuals to prepare for this by reducing their exposure to equities and increasing their holdings of treasury notes and cash. Real estate, especially residential and income-producing properties, may also be a good investment option. Rickards said unemployment is a lagging indicator of a recession, which means that it often takes time for the negative effects of a recession to show up in the job market. This is because companies may try to hold on to their employees as long as as possible, but eventually they may be forced to lay off workers due to declining profits or demand for their products or services. In addition, small businesses may fail during a recession, resulting in job losses. Unfortunately, the two experts suggest we may be heading towards a severe recession in the US, which could lead to a significant increase in unemployment. The Federal Reserve has been raising interest rates to combat inflation, which is good, but it could also lead to an economic slowdown and job losses. This is why individuals need to be prepared to protect themselves. This includes reducing their exposure to equities, holding cash, investing in high-quality bonds, and diversifying their portfolios with assets like gold, real estate, and silver. Furthermore, both experts emphasizes the importance of being honest and realistic about the current economic situations in the US, and this includes the potential for a severe recession and increasing unemployment rates. However, they also provide solutions and recommendations to help individuals and investors prepare and protect their portfolios. And by acknowledging the challenges ahead and taking protective steps to mitigate risks, individuals can better position themselves for success in the face of economic uncertainty. A famous quote from Robert Kiyosaki states that the smart investors always look for the bright side of a recession, which is the opportunity to buy assets at bargain prices. What this means that during a recession, prices of assets like stocks, real estate, and businesses go down. This provides a great opportunity for smart investors to purchase these assets at lower prices, with the expectation of their value increasing when the economy recovers. Inflation, on the other hand, can erode the value of money over time, making it important to invest in assets that can keep up with or outpace inflation. So, what are your thoughts on the perspectives of these two financial experts? And how do you intend to expand the variety of investments in your portfolio this 2023? Let me know your thoughts in the comment section down below. And that's it for this video. Thank you for tuning in to the end. We appreciate your support and hope you enjoyed the video. Don't forget to give us a thumbs up, hit the subscribe button, and turn on the notification so you never miss an upload from us. Your engagement helps us bring you even more exciting content in the future. Until next time, and take care.